Hey guys, welcome to my new video Candlesticks Pattern Basic Course number 3. We will talk about all bearish reversal candlestick pattern that you will ever need to know. In my Patterns Basic Course 1 and 2, we looked at the trend continuation candlesticks pattern and the bullish reversal candlestick patterns. Now we will get into all bearish reversal candlesticks pattern that you need to know and what amazingly effective tool they can be used for in your trading. If you missed course 1 and 2, go ahead and watch them right after this one, and make sure to subscribe to my channel to get notified as soon as a new video is coming online. Now let's get into the course. Bearish reversal candlesticks pattern indicate that the ongoing uptrend will turn into a downtrend. This is why traders should be cautious about their long positions when the bearish reversal candlesticks pattern are forming. The patterns can also be used to find an entry for a short position, but always remember not to use a pattern by itself for its strategy. It's only to use in addition to technical analysis and indicators. Now let's start with our first pattern, the Hanging Man candlesticks. The Hanging Man is a single candlestick pattern formed at the end of an uptrend, signaling a bearish reversal. It is a bearish candle with a small body, and the wick at the top should be small as well, or no wick at all. The lower wick is much longer, and it should be more than twice as long as the body's size. The psychology behind this candle formation is that the first sellers have pushed the price down, but then buyers entered the market and suddenly pushed the price higher. But they were not successful, as the candle closed with a lower price than the opening price. This means that the sellers are back in the market and the uptrend could end. But before entering any short position, you need confirmation. Always remember that. A hanging man by itself is not an indication enough to get active in the market. Let's jump to our bearish reversal candlesticks pattern number 2, the dark cloud candlestick. The dark cloud candlesticks pattern is a 2-candle pattern. The first candle is bullish and indicates the continuation of the uptrend. The second one is a bearish candle that opens with a gap up but then closes below more than 50% of the previous candle's actual body. This shows that the bears are back in the market and a bearish reversal is possible to take place. Our bearish reversal candlestick pattern number 3 is our bearish engulfing candlesticks. It is a multiple candlesticks pattern consisting of 2 candles. The first candle is a bullish one, indicating the continuation of the uptrend, but the second one is long and bearish and completely engulfs the first candlestick. This shows us that the bears are back in the market. Now let's jump to our bearish reversal candlesticks pattern number 4, the evening star. The evening star candlesticks pattern is made of 3 candlesticks, representing all 3 types of candlesticks. The first one is a bullish candle, indicating the trend continuation long. But the second one should be a doji, but can also be a spinning top, both representing indecision in the market. And the third candle finally is a bearish one that shows that the bears are back in the market and a reversal is likely to take place. What's also important, the second candle should be completely out of the price range of the real bodies of the first and the third candle. Now let's jump ahead to our bearish reversal candlesticks pattern number 5, the 3 black crows. The 3 black crows pattern consists of 3 long-bodied bearish candles that open with the previous candle's real body, meaning with a gap up and close lower than the previous candle. The candles also do not have long wicks at all. Why black crows? Because in a black and a white candle chart, short candles are always black and long candles are white. So these 3 short candles are called the black crows. The opposite pattern for bullish reversals is therefore called the 3 white soldiers. We talked about them in my Candlesticks Pattern Basic Course Part 2 about the bullish reversal patterns. So let's get back to the 3 black crows. If the market is in an uptrend and they are formed, give it close attention. The 3 black crows are considered a reliable reversal pattern when confirmed by other technical indicators like the Relative Strength Index, RSI, that we have talked about in an earlier video. Also, the size of the candles and the length of the shadow is used to judge whether there is a risk of retracement. Now let's look into the bearish reversal candlesticks pattern number 6, the black Marubozu candlesticks. The black Marubozu is a single candlestick pattern, and also the opposite of the white Marubozu from the bullish reversal patterns. If it's formed after an uptrend, it is indicating a bearish reversal. The candlestick has a long red bearish body with no wicks, neither at the top nor at the bottom. This shows us that there is selling pressure coming from the bears and the markets may turn short. Now let's jump to bearish reversal candlesticks pattern 7, the 3 inside down candlesticks. Like you may have noticed, there are a lot of candlestick patterns that work both ways. The opposite of many patterns that work for a bullish reversal work with the opposite candles for a bearish reversal as well. So the 3 inside down candlesticks pattern is also one of them. Like the bullish opposite pattern, it consists of 3 candlesticks. In this case, the first one is a long bullish candle, indicating a continuation of the long trend, and it's followed by a small bearish candle, which should be in the range of the first candlestick. The third candle finally should be a long bearish one to confirm the bearish reversal. The relationship of the first and the second candle, the second one being in the range of the bigger green one, is also called bearish harami candlesticks pattern, and also an indicator for a possible reversal in a bull trend. This is why our pattern number 8, surprise, is the bearish harami candlesticks pattern. As just mentioned, the bearish harami is a 2-candle candlesticks pattern. It consists of a tall bullish candle, followed by a second candle being small and bearish, and formed within the range of the first candlestick. The first bullish candle indicates the continuation of the bullish trend, and the second candle shows that this might be wrong. It is possible that the bears are back in the market. Therefore, it's important to confirm the possible reversal with another indicator, for example. Now let's have a look at our bearish reversal candlesticks pattern number 9. It's the shooting star candlesticks pattern. The shooting star is a single candle pattern. As you might see, it is the reversal of the hanging man candlesticks pattern, our today's bearish candlesticks pattern number 1. The body of the red shooting star candle is not too big and the lower wick neither, if there's one at all. The star itself is shooting in the short direction and leaves stardust in the form of a long upper wick which should have at least twice the length of the candle's body. A pretty romantic candlesticks pattern, don't you think? Now let's have a look at bearish reversal candlesticks pattern number 10, the tweezer top candlesticks. The tweezer top candlesticks pattern is a bearish reversal candlesticks pattern consisting of 2 candlesticks. The first one is bullish and the second one bearish. What characterizes the pattern is that both candlesticks make the same or almost the same high. When the tweezer top candlesticks pattern is formed in an uptrend, at first the bullish candlestick indicates a continuation of the ongoing uptrend. But the second candle being bearish and opening almost at the same level, like the green one closed, indicates a support level. The bulls seem not to be willing to buy at higher prices anymore. The tops of the candles indicate the strength of resistance and signal that the uptrend may get reversed to form a downtrend. Now let's go ahead to bearish reversal candlesticks pattern number 11. The 3 outside down candlesticks. The 3 outside down candlesticks pattern consists of 3 candlesticks like the name already suggests. So the first one is a bullish candle, followed by the second candlestick being large and bearish, which should cover the first whole candlestick. The third candle is also a bearish long candle, confirming the bearish reversal. The relationship of the first and the second candlestick is the bearish engulfing candlesticks pattern, like you learned in this course's pattern number 3. We're almost there. Now we have a look at our bearish reversal candlesticks pattern number 12. The bearish counterattack candlesticks. The bearish counterattack lines is a 2-bar pattern. In order for the pattern to take place, there must be a strong uptrend in the market. The first candle must be a long-bodied green bullish candle, and the second one must also be a long-bodied but bearish candle. Ideally, they are equal in size to the first candle. The second one opens with a gap, but then closes near the close of the first candle. It shows us that the buyers may be losing control, since the sellers were able to close the gap up. This is our Bearish Reversal Candlesticks pattern course. If you enjoyed this content, please leave me a thumb up and subscribe to my channel. And if you have any questions or suggestions, please leave me a comment and I'll be happy to answer you. See you in my next video. Have a good day and see you soon. Bye bye.